think the fund accounting for the textbook problem, and then we got another textbook problems that we're gonna do, 42 and 43. And that'll be, hopefully it'll be a shorter class. I don't want to promise that. All right, so I think problem 39. I gave you guys to do it as homework, and I think we'll just go ahead and go through and put them in. If you already have them, you're going to say them out loud or put them in the text message, or not text message, in chat. Sorry. Feel free, but okay, the government sells bonds at face value to finance construction of a warehouse. I'll put in the easy part. Oops. So we get the cash. 900,000. That was the easy part. Okay. What goes on the other side?
I believe I put bonds.
In normal accounting, it would be. I think on the, let me take a look at what we did on the other one. Yeah, and then in normal accounting, yeah, we've had bonds payable, like the government-wide ones. But fund accounting, we call it something different. We don't have any long-term liabilities. Did we have it on the previous problem? I can't remember. Yeah, here we go. It's another financing source. We don't have any long-term liabilities on fund accounting. So it is called this other financing source. And it's literally almost like a revenue account. I know it, you're saying to yourself, that's a liability, but we just figured it as a way to pay the bills, basically. Now, this would probably be sold right into the capital projects fund. Well, this would probably go right to the capital project. It could go into the general fund and then be transferred to the capital projects fund, but it could also just go right into the capital projects fund. Next one would also be in there. Now, they signed a contract. Now, in regular accounting, when we sign a contract, we don't do anything with it because, nothing's happened. But in fund accounting, when we sign a contract or when we sign purchase orders or something that we need to keep that money away from so someone else doesn't spend it, basically. What accounts do we use? We want to put our hand on the money.
Wouldn't it be encumbrance and then an encumbrance outstanding?
Yes. Yep. And these are budget accounts. They do not go on the financial statements. 1 million. So we put our hand on the money. This one I should have broken up into two different problems. I think on the next problem that we do, on problem 42 and 43, I do break it up. Government transfers 130,000 unrestricted funds to the eventual payment of the debt in A. Okay, so we're gonna set aside 130,000 to help pay off that debt. So this would be in the so the general fund, excuse me. Well, you know, I can do right in here. Making this more difficult than I need to. Okay, in the general fund, what would the transaction look like? I'll give you the easy part. The easy part is they're sending out $130,000 in cash to pay for the debt. Now, notice that the general fund is not actually spending the money. They're giving it to a different fund to spend the money. And the fund they're giving it to, we'll put that in right now. The debt service fund, they're the fund that actually pays for the long-term debt. So the general fund is not spending the money themselves. It's not going to be an expenditure. But they are sending it to somebody else. So what kind of account are we going to use for that? Starts with a T. R. A. N. Oh, come on, you guys. Yes.
Transaction.
Transfer.
Transfer out.
Yes, transfers out. Oh, maybe I don't have one up here. That's why you guys aren't jumping in. All right. Well, actually, it's not to just say transfers out. You can just say transfers out. That's fine too. All right. Okay. Now, the debt service fund will be getting the cash. What are they going to have on their books? Instead of other financing use, they'll have other financing source. Transfers in. Oops. All kinds of troubles. Here we go. It's not going to work. Okay. My computer got stubborn here. Okay, so the general fund's going to have a transfer out. Debt service fund's going to pick it up as a transfer in. Okay, now this is the one that was kind of vague on the last one. It makes more sense on this one. Oops. More sense if I put the right lowercase letter there. So the government receives equipment with a cost of 12,000, when ordered the anticipated cost was 11,800. Now remember, this is fund accounting, so when we ordered it, what did we most likely do? We set up one of these. So when it comes in, we have to take our hand off the money. Now here, how much money are we going to take our hand off of? We ordered it, we thought it was going to be this 11,800. When it came in, it was 12,000.
The 12,000.
Actually, when we put it on the books, we probably put our hand on 11,800. Is that right? Let me read this again. We don't receive from the cost of, and then yeah. So this is what we probably put our put our hand on the money for, was the so this is what we're going to take off. So we're just going to reverse this entry. I know it's kind of silly, you put it on and reverse out, but it does do a purpose. It's on the book so that people know not to spend it again. So they probably put on the books the 11,800. So now we got to take our hands off 11,800. A different way of doing things. It's definitely okay. Now it doesn't say we paid it, and I'm assuming this is somebody outside the government, so we'll put this out as a vouchers payable. It's the accounts payable, so it doesn't matter to me. And I know I told you this before, but there's a lot of businesses that use vouchers payable. It's not a governmental thing. So it came with a cost of 12,000. Now, what's the wacky account that we use on the other side? Give you a hint, we use it for everything in fund accounting, whenever we buy something or whatever. Expenditure, yep. So, normally you'd say put the equipment on the books, but in governmental accounting, we just got a checkbook. You don't put equipment in your checkbook. So it's just an expenditure. And eventually this will get paid off, obviously, out of the checkbook. It's like when it comes to these encumbrances, I don't put liability or asset or anything on there because it's not. These are completely separate from the financial statement. Actually, we'll see that later on today. Okay. Supplies to be used in the schools are bought for $2,000 cash. The consumption method is used. Okay. So this one actually is more straightforward than it sounds. So supplies. So in this case, they are going to put the supplies on the books. Now, if you're wondering why do they put supplies on the books? If you think about it, supplies are actually usually a current asset. So, we do have current assets on our books. So sometimes they'll put the supplies on the books. They can also just, I shouldn't say expensive, but expenditure them. And sometimes they won't have them on the books, so this count as an expenditure right away. But sometimes they'll put them on the books, and they do this for kind of a control thing. So supplies are actually a current asset. So sometimes they will have supplies, inventory, things like that on the books that are current. So what's going to be on the other side? What happened to elements? I'll give
Sorry,
you-
with the dash.
Yeah.
I'm screaming into the mute button, to the mute.
My last night class, I spent about 15 minutes talking to myself. I think everyone enjoyed that though. All right, so supply using school about for $2,000 cash. And again, this is one of the weird ones that because they are putting it on the books, they're recording on the books, and then they're going to expend them as they use them. We'll put them on there, and it's really not going against our idea of only current assets because supplies is a current asset. Okay, the state awards a grant of $90,000 to supplement police salaries. Money will be paid to reimburse the government, but only after the supplement payments have been made. Okay, this is a kind of weird one.
Would it be due from state, 90,000 and then unearned rev?
Yeah. Oops. Yeah, so differently, so this is an asset. Going up. And unearned, now, sometimes they will use, and I think the new correct terminology, I'm not gonna worry too much about it because I still see unearned revenue used, but the newer terminology is unavailable. Okay. And here's why I think that they went to that unavailable revenue, and that is that revenue is generally not earned by government agencies. So sometimes they'll just call it unavailable revenue. It doesn't matter. They mean the same thing. Now, we'll find out on the financial statements that they'll break out this unavailable revenue or unearned revenue, if depending on what terminology they use, they break it out separately. They actually, so it looks like this on the balance sheet. You know, usually you're used to liabilities and then equity, right? And so in the past, it was liabilities and then fund balance. Fund balance was the equity, basically. Now they do liabilities and then unavailable funds. In other words, stuff that you can't use yet. It's sort of like unearned revenue. But there's I think it's because there's so much of it in governmental accounting that, that it can only be spent in certain years or after certain conditions are met. That they break it out separately, like, hey, this isn't a liability because it needs to be paid off. This is a liability because the money needs to be expended for whatever purpose it is, which is a little bit different. It's not like you're paying off a creditor. So they're breaking those out separately. We'll get to that later. But this unavailable is kind of a new term. Government nails tax. Yeah, okay, let's see here. What's the journal like with this one?
Taxes receivable, 600,000, estimated uncollectible, and then revenue taxes. Nice.
Yep, and this is asset going up. All right, so that's 600,000. What is that? 600,000, like 4%, was that 24,000? Nice, we go. And then we'll pick up the revenue. Oops. I'll say tax revenue if you want it. Some kind of revenue. 576. Okay, is that it? Hey, hey. Yeah, so it's kind of wacky. It's a wacky way of doing it, but it actually works for what what we need it for. It works for basically for a checkbook. It's sort of like a checkbook, and in a checkbook you don't have long-term. I don't want to do that. Undo that. You don't have. This should be indented those. You think about your own checkbook. The only asset you have basically is cash. A little bit of a, I don't say change, but we do record supplies if we're using a certain method to do it. The consumption method means as you consume them, that's when you expend them. So, yeah. Okay, I think we're done with this one. Hey. Okay, well, let's go on to the next one. And we're going to do a few more. We're going to do one more kind of a journal entry problem one. Just because the more you do it, like anything, the more you do it, the better you get at it. Wait a minute. And then we're going to get into the financial statements, the fund accounting financial statements. Okay, on this one, I set it up so that we can just highlight whatever fund we're going to use for this. This is problem 42. I altered it a little bit. I actually knocked off a couple of them. But anyway. Okay, so we're going to start out with fund accounting like we just did. And remember, this one is fund accounting is fun. So that's how we remember this one. Because it's wacky. Okay. What do they want us to do here? My guess is this is the budget. All right, so this will be the general fund. And the budget, you recall, is a very strange entry. It does not go on any financial statements, but it is required to be put on the books. It's a legal budget, and it's on there so that people know exactly what they anticipate to spend and how they anticipate to cover that. Okay, so we'll have estimated revenue. Of 834. Approved spending. These are sort of like the estimated expenditures. And you're probably thinking, well, we probably just put on estimated expenditures. Actually, we don't. We call them appropriations. So this is gonna be appropriations, and if you're in government, you hear that term a lot, appropriations. And one of the most powerful positions you can have in Congress is being on the Appropriations Committee, because that's how they spend all the money, and people who are on the Appropriations Committee generally, wherever they're from, is rewarded for them being on that committee. So it's a very prized committee to be on the Appropriations Committee of any government agency, but especially in the US government. Okay. Estimated other financing use. Transfers out. That's not how you spell estimated. That's how you spell estimate. Okay, now for the fun part. Oops. So we have 834 on one side, we have 782 on the other. So we need a credit of how much? Oops. You gotta turn on the calculator. Write that down. All right, 782.
52,000.
Hello.
Hello.
Sorry. 52,000.
So this will be our budgeted fund balance. And by the way, there are some accounting that they don't use the budgeted fund balance, they use some other kind of fund balance and back it out. The AICPA is really, yeah, they want you to use the budgeted fund balance. So that it doesn't get confused with the regular fund balance. Okay, so this is in the general fund and we put that on the books. It's a legal budget. I guess we can take these off now. It's a legal budget and they put it on the books. It's just sits on the books all year. They might change it a little bit. Sometimes they'll go back and look at it again, but if they don't, it'll sit on the books the entire year and then they reverse this entry off. Excuse me. All right. B, contract signed for central office construction. What fund are we probably going to look at for this? Which one of these funds? Anyone? When we're going to build something, what fund do you think we use? Oh, you guys know this one. You're toying with me.
Capital projects?
Yep. Yeah, capital projects fund that's a fund that we use, and sometimes they're a fund that's always open, for certain things, but sometimes they'll be specific to a project. Like this looks like a central office building or of some sort, so this is probably gonna be a specific project that they're going to work on. When I say that they're open, for instance, sometimes you'll have like street projects and things like that. That will just be an open, that they'll keep track of them, but they'll just be one that is just constantly, they're just constantly keeping track, and they refund it, I mean, they fund it to whatever they need to get done. They leave it open, but a lot of times if they're specific, like for this certain building or this certain bridge or this certain whatever, then they'll make it into its own separate fund it, and all that. When it gets completed, then they take it, they close it out. But they do that so that, for budgeting reasons and all that. Okay, so now this is all part of the fund accounting. They sign the contract. Now, nothing's happened yet, but they signed a contract for $8 million. So what journal entry are we going to do? Now, in regular accounting, we wouldn't do anything because nothing's happened yet. They signed the contract, we don't know if they're going to show up. But in governmental accounting, we have to make sure that money's there. So what kind of accounts are we going to use?
Encumbrance, right?
Yep. We're gonna put our hand on the money. $8 million. Encumbrances outstanding. And again, these are just budget accounts. They are not on any financial statement. But what they do tell is people don't spend this money. It's already spent. Okay, bonds sold at face value for the $8 million.
Cash 8 million.
Yep.
Then bonds payable 8 million.
In normal accounting, yes, but this is wacky governmental accounting. We don't have long-term liabilities on the books. Well, first of all, I should tell you what fund we're going to use. We're using a capital fund here because this is how they're going to get money. They have to pay for this building at some point. So this is what they're doing to get the money. They're sending out the bonds. Now, we don't have long-term bonds on our books for fund accounting. We use the other financing. Now, is this going to be another finance?
Vouchers, is it vouchers payable?
Not yet. It will be.
No.
It might be. I have to look at the other one actually.
Okay.
And it's just going to be like money coming from heaven. It's going to be almost like a revenue. It's going to be other
Other
finance.
financing source?
Yep, exactly. Good. Yeah, it's not. Yeah, it's not a use. It's going to be a source because this is how they're getting money in. So other. And again, this is not a liability account. We don't have long-term liabilities on the books. So we pick it up. It literally almost shows up like income, basically. So if you're wondering why our governments are, so far in debt, this is why, one of the reasons why. You take out a loan and it's kind of like getting income, kind of like, revenue. And again, this fund accounting, as wacky as it was, this is all we had for years. When I graduated from accounting in 91, this is all we had. This came out, the other one, the government-wide one came out in 1993. I know it's ancient history, you guys, but it's not that long ago. And so you can see how government's got into real problems. Okay, invoice received and paid when building was completed.
So this, you have to reverse the encumbrance and encumbrance outstanding for 8 million.
Yep. Let me reverse that out. So we're going to take our hand off the money. And now we're going to spend it. And
Then you paid cash for it, probably.
Yep.
Or, yeah.
so what journal entries are going to use? I'll put the cash on. Let me put the cash on. So cash, we're paying out the cash now.
Would it be the building?
Yeah, but what do we call it? Oh, first of all, this is a capital projects. Now, we don't have long-term liabilities. We also don't have long-term assets on the books.
So would this one be the appropriation?
It actually will be similar to appropriations. These are just estimated expenditures, but this will just be an expenditure.
Oh, just make it an expenditure. Okay,
But appropriations are estimated expenditures.
okay.
And why don't they call it that? I have no idea, but that's what it's called. Yeah, so this is just an expenditure. And so, if this was all that they had, and this came out exactly the same. So if they had other financing source bonds, this would be the only thing left on the books. This would be the only thing left on the books expenditures. You just reverse that entry and it close out the entire thing. Like it never happened. Except for these $8 million worth of bonds that are hanging around. Yeah. Somebody would say, well, what if there's money left over? What if the building came in at, I don't know, 7,800,000, whatever. Usually that would get transferred back to probably get transferred back to the debt service fund, because they're going to start paying off this 800,000, but it could also get transferred to the general fund. Now, see, they come up short, then somebody has to fund it. From the outside, to get another other financing source from somewhere. Okay. Okay, previously unrestricted cash set aside to pay bonds from C. So $8 million bond. Yep. Okay. So we aren't completely unresponsible. We are non-responsible, whatever you call it. Irresponsible. So that's what I'm looking for. We're not completely irresponsible. We do set aside money to pay off these things. Now, unrestricted cash, this is going to be coming from the general fund. The unrestricted fund balance is only in the general fund. And I know that that's a weird definition kind of thing. When you guys sit for the CPA exam, that's one of those things you memorize like the night before you go in. But so unrestricted fund is only in the general fund. So the general fund, we are going to put money into the debt service fund. The debt service fund are the ones that pay off the bonds. So the general fund doesn't pay them off. The debt service fund does. So we're gonna take money from the general fund and put it in the debt service fund. So what is that gonna look like? So the general fund isn't spending it. It's not gonna be an expenditure. Because they're not spending the money. They're gonna give it to the capital projects fund, and the capital projects fund, they're the ones that are going to spend the money. We did it already, didn't we? Maybe not. We did it on the previous problem. Well, here, I'll give you the easy part of the general fund. They're gonna give cash to the debt service fund. $1 million. I'll give you, okay, someone, I think someone is,
Other financing use transfer?
yes. Perfect. Everybody, yeah, so this will be transferring out. Excuse me, I just sneezed. All right, so what's gonna be on the other side? So now the debt service fund, they are going to get the cash. So to them, it's money coming in. What's it gonna be to them?
Now, is this one gonna be vouchers payable, Professor?
Nope.
Still no?
Okay, they're just getting that this money just showed up on their doorstep from the general fund. So for general fund is another financing use.
Mm-hmm.
What's it gonna be for the debt service fund? Other financing, you think you got it?
Other financing source bonds?
Yep. Yeah, not bonds, but it'll be a transfer in. But it'd be
Okay.
other financing use. Yeah, I said it wrong. Other financing source.
Okay.
Don't listen to what I'm saying.
But they're paying for the bonds or no, it's,
Yeah, actually, I think on the next one we pay for it.
okay, on the next one, okay.
Yeah, but yeah, so they got this money and this money will be. The debt service fund, they're the only ones that pay the long-term stuff. So this money, anything that they get, and by the way, all they have in the debt service fund, they're just gonna have cash and possibly investments. That's all they have. They don't have anything else in it. It's simply a check writing group. Okay. Bonds portion comes due and is paid $1 million. Portion of the payment representing interest is 100,000. Okay, so I will put the easy one up. So they're paying cash out of $1 million. And of that $1 million, interest is 100,000. Now, this is a government fund. They actually do not have any long-term liabilities on the books. Normally you say, oh, they're paying off bonds payable and interest expense, right? They don't have any bonds payable on the books. What is it when you pay for anything, basically, in governmental accounting, with the exception of supplies? What's the account for everything?
Other financing source.
Expenditures?
Yep, expenditure.
Okay.
So it looked like this, and this was, you might separate these out, expenditure, interest. Principal. Forgot. So this is what it looked like, but they're just expenditures. And again, a governmental accounting, they don't have it. The only place that they used to have, they still might have it. There was a, it wasn't required, but it was a listing of debt, long-term debt listing that government agencies, could use and could publish. But it was just a list of all the long-term liabilities, basically. But it was not connected to any fund. It was just expenditures being paid out of the debt service fund. Okay, property tax levy or assessed at 800,000. Collectible is 90%. So we're going to collect. What is that? 720,000. All right, collectible in subsequent periods, so this is going to be earned revenue, 6%, oops, no, wait, times 800,000. And for Mr. Calculator.
48,000.
48,000.
Okay. And from, yeah. And the remainder expected to be collectible, is expected to be uncollectible. Okay, well, that would just be, well, 800 minus those two, right? I'm gonna put it down here. So 800,000. Oops.
32,000.
32. Thank you. Yeah, so my 720 minus 48, it's that comes off 32. Yeah, yep, that is 32. Okay, so this would be 720. Okay, so our journal entry, what would it look like? First of all, I didn't put what this is. This is general fund. And I also didn't put what this one was up here. This is debt service fund. Oops. Did I do that one? Okay, I did that one. All right, so what are we gonna put in the books here for this? So the property taxes are sent out. What accounts we're gonna use? It's our last one before we go on break, guys. We got two little dogs upstairs. They have to go bother the neighbors for 10 minutes. What accounts we use? Actually, I think we did it in the last one. Taxes receivable. This is an asset. 800,000. Uncollectible. 32,000. Deferred revenue, that's the revenue we cannot use until subsequent periods. They don't tell us what year this is, but we can't use 48,000 of this in this year because it'll be collected after the 60 days. That's the end of the year. And we will have revenue of. Let's give revenue capitals. $720. So this is what we're going to be able to spend in the current year. $720. You know, this we're not going to collect. This we have to wait till next year to spend it. So in the current year, we're going to bill out 800,000, but we're really going to take in an estimated 720,000. Okay. Let's say be back at 6:57, so 7:07. Okay, now we're back to normal accounting. Or kind of we're used to, I guess, maybe a better way to put it. Yeah, so this is the government wide. Now, the government wide is similar to what we're used to. You know, we have long-term assets, we have long-term liabilities on the books. It's more along the same lines as what we are used to. We do not make budgeting entries. We also don't make entries between, when there's transfers between funds that are in the same group. So for instance, transfers between the general fund and the debt service fund, we don't record those. It's all, you know, it's like saying, like I said, like you give a, let's say that the marketing department gave a chair to the accounting department. You're not gonna make a journal entry for that. If the company has, you know, they have the same chair, it's just they moved it in a different spot, it doesn't really matter. Same thing here, they have the same cash, it's just they moved it to a different spot. So transfers between government agencies, they usually don't do anything with that. The only time that they would have do something like that is if there's actually a service or something, because if one was like an enterprise fund that made money, but other than that, they don't record those. So a little bit different, kind of more like we're used to, let's say. So here's a budget, and we don't do anything with it. And by the way, this is why this is one reason why this is kind of hard to teach, because you go, okay, here's the checkbook version. You know, you have all these transfers and all this stuff, and it's legal. You know, it's kind of like you're trying to legally stay within this budget. But and then you go to the regular accounting, and you know, so it isn't just that you can jump into this other world. When I went through, you could just jump into the other world and be governmental accounting and never think about the other way, you know, of normal accounting, where this one you kind of use both, because government wide is sort of like our regular accounting that we're used to, and the government accounting is wacky. Okay, so no entry. Signed a contract. No entry. I'm liking this way better already. Yeah, no entry. We don't use budget accounts. Okay, sold bonds at face value, 800,000, excuse me. Now, we do have long-term liabilities on the books. I'll do the easy part.
And then bonds payable.
Yep, very good. And is a liability going up? We have long-term liabilities on the books. Invoice received and paid when the building was completed. Okay, we don't have to we don't have to do anything with encumbrance accounts. You know, I shouldn't have these in there because those are not, you know, I wasn't paying attention when I did this handout. We're not going to use any of those on government wide. And government wide, these are all the same. These are all the same group. Government wide is okay, those are all the same people that, you know, whatever happens between them, I don't care. All right, so received and paid the bit when the building was completed, 800,000. So we got this 800,000 in cash from the bonds. They made the building. Now we do put long-term assets on the books. and we paid him for it. I'll do the easy part. Oops, because it's not so easy. Cash. I'll tell you what it's not. It's not expenditure. We put long-term assets on the books in this method. And by the way, we put all long-term assets on the books. So we'll put on the building, land building, property, plant, equipment, land building and equipment. But we also have things like streets, bridges, on ramps, all that kind of stuff. Those are all also get put on the books for using this method. So you can't have streets on the books and that sort of thing. So what are we gonna need to put on the other side of this?
Due to?
Probably not. This is I assume this was a contractor that we paid, right? It doesn't really say. We're just gonna put the building on. You think about this is gonna be bonds payable, the liability, 8 million, and we're gonna have the building. 8 million. And these, I shouldn't have these in there. Those are all considered the same group for this method. Okay, so this is just issued bonds, paid for the building, that's it. If it is possible that if you're making the building throughout the year, you'd have what they call construction in process, CIP. Construction in process is as you're building it, and until you get it built, you're gonna have a construction in process. And then once it's done, then you transfer it from construction in process to building. It's because at some point we start using it. But that's just regular, that's the same thing as for regular accounting, construction in process. Okay. Now, really, I'm just saying cash set aside to pay bonds. Okay, so this is basically this. This is the government agency, transferring money to another government, no entry. It's like moving a chair from marketing to accounting, or the other way around. So, if it's between these accounts, any of these accounts, we don't do anything with it. In government-wide accounting. Okay, portion of bonds comes due and is paid. Okay, so this one is. Now, this interest. It's sort of like an expenditure, but we're just gonna call it interest expense. We have expenses in this method. And at 900,000, what is that paying down?
It's paying back on the bond, so bond payable.
So that's a liability going down. We now paid off 900,000 of it. This one's gonna be exactly the same. Here, I'll show you guys how to be lazy like me. Let's copy it. Whoa, don't be lazy like me. It's much more work for myself. There we go. Yeah, I guess the key there is not to be too lazy. You gotta be. All right. Yeah, so this will be the same thing. And like on a test, you know, if you run into this, because I will give you on a test the 2 different ways of doing it. So copy it, copy paste. The tax, the revenues are the same between both of them. If there's one thing that's constant between both of them, it's the revenues. And it's because they really don't earn the revenues. Okay. Let's see how, I think we should probably be able to get this. All right, so fund accounting financial statement format. So this one is, we basically have 2 types of financial statements. One is the balance sheet, which is a little bit different than what we're used to, but I'll show you what that is. So, and then statement of revenues, expenditures, and other changes in fund balance. So this is similar to the income statement. I'll put that in there. So this is similar to an income statement. Now, this is for fund accounting. This is for the wacky governmental one. So we don't have expenses, but we have expenditures. Okay, fair enough, right? But now remember, these expenditures, they have everything. You know, your expenditures are going to have, you buy a building, it's an expenditure. You buy a truck, it's expenditure. You pay for you pay off part of your debt, it's an expenditure. Everything's an expenditure. So it's a little bit, even that right off the bat is going to be a little bit different. It's not necessarily an expense. You know, for example, here I'll show you like a stark example of that. Here we have this payment, and notice that only the 100,000 is an expense, right? For government wide. So if we were making an income statement, only that expense of 100,000 be on the income statement. The rest of that is a liability. Go back to, go back to here. You know, the expenditure is going to be $1 million. So expenses and expenditures are, while they're similar, they're not the same thing. So anyway, so these expenditures, these are basically all payouts for everything. And so you can have an excess or deficiency. And a lot of times there is a deficiency. And that's because coming down here, we have other financing sources. So this is actually money coming in or money going out for other finance. So if you sell bonds, it'll be down here, almost like a revenue. If you pay off, or if you transfer money to somebody else, it'll be on here as kind of like an expenditure. Money comes transferring in, it's kind of like a revenue. So we have all these pluses and other financing sources and uses that can really be large. You know, that you know, that $8 million bond would come in here almost like a revenue. It won't be up here in the revenues, but it'll be added in to it. Okay, coming down here to the balance sheet. So we have our assets, is like you would expect. But they're only current assets. We don't have any long-term assets. We don't have buildings, we don't have you know, equipment, we don't have land, don't have streets, don't have bridges, don't have any of that. There's only current assets. There's basically going to be cash, receivables, and maybe some inventory. All right, so on the other side, we're going to have liabilities, but those liabilities are only current liabilities. We don't have bonds, we don't have any, you know, long-term stuff. A new category is deferred inflows and resources. Our fund balance is similar to, this is similar to the equity. Sorry about that. Now, it isn't the equity section because nobody owns City of Chicago or whatever. But those all go in there. So while we have these, you know, we have 3 of them basically on this now. And this is the new one. If you're going to get tested on the CPA exam, it's going to be this one. That's just the way they, you know, whenever something new comes out, that's the one they always hit. So the deferred inflows, unavailable revenues, or deferred revenues could be in there too. Whatever revenues are not available. Okay. So what we're going to do here is kind of fill in the financial statement. So the first one we're going to do here is basically the income statement. And we're going to use these accounts up here to kind of fill it in. All right. What is that? Like some kind of wacky. Oops. Like some kind of weird little number things or something. Make sure these all line up. Okay, I'm not sure. Oh, you know what I bet it is? I think I know what it is. Ha, see? Tucked in there was bond proceeds. Okay, sorry about that. If you want to move that out, you can. All right, so what we're gonna do is just kind of cut and paste these in here. Now, it doesn't matter to me what rows you use here. Okay, our revenues are how much? How much do we have in revenues? We're just gonna use a 760. So these are just gonna go in by themselves, by the way. So this will just be the revenue 760, so I'm gonna use it. I'll mark these as green as we go. Okay, so this will be 760. And what do we have in the expenditures? 30. So this is money going out, so I put that as a negative. And again, this expenditure says everything, This is buying equipment, paying salaries, buying buildings, making a bridge. Okay, so this excess deficiency over revenues over expenditures, this is sort of like our gross margin, gross profits, something like that. You know, it's kind of a stopping point before you figure out the rest of this. And, you know, the weird thing is that these expenditures will, sometimes they break them out, so sometimes they just go in as one line item. Okay, so 760 million. 230,000. Okay. Now, other financing sources and uses. Okay, so that would be down here. Okay, other financing sources, bond proceeds, copy that. Just gonna need that green in there, do I? What is that? 300,000. So he sold bonds, 300,000. Notice that's, notice how wacky that is. This is a long-term liability, and it's showing up on our, basically on our income statement. Other financing sources, transfers in. And again, that shows up sort of like revenue. Other financing uses, transfers out. Oops, did that wrong. So that will be a negative. Okay, so under this section. Whatever that comes up to. What is that? 470? No, 350 minus 470, that'd be a negative something. Negative 120,000. Okay, so this will be our change in fund balance. 230 minus 120. $110. Our fund balance, the beginning of our fund balance was, this is kind of like retained earnings, or beginning retained earnings, but this is fund balance. Unassigned. There's no other fund balance, so that'll be the only fund balance we have. 170,000. $110. So here's the change in the fund balance. Here's what was at the beginning. So the ending fund balance will be 280. 280,000. So this is sort of, you know, this change in fund balance is sort of like income. how much did our fund balance change? It went up by 110. If we had 170 sitting in there, now we have 280 sitting in. I was just talking to myself again. So let's come down here. Now we're gonna do the balance sheet. Now the balance sheet's gonna have everything else on it. So let's see here. I'm gonna just kind of take a look here and see what we have already taken out here. Okay, so let's come down here and play. Where does it go? So first one, accounts payable. Where does it go?
Liabilities.
So accounts payable. I should start highlighting these after I put them in. Oops, wrong place. So accounts payable, what was it, 90,000? Center these. Okay, cash. Where's the cash gonna go?
Asset.
30. Contracts payable.
Liabilities.
90,000. Are they both 90,000? They are both 90,000. Here's the wacky one. Unavailable revenues.
Liabilities.
It actually kind of is like a liability, but it actually gets put into its own little group here. Deferred inflows or resources. And I think the reason for doing that is that it's not something that's usually paid back. It's usually something that just has to be expended for whatever the purpose is. Whatever, this is a new one though. That unavailable revenues is new, and this heading is new. So this is one of those, if they're gonna test you on something, this might be it. Because it's new. Okay. Now be careful of the due tos and due froms. Due from means that they owe us. Due to means that we owe them. So this due to capital projects fund, I'll give you a choice. Is it gonna be a liability or an asset?
Would that be a asset?
Yep, very good. Yeah, it's kind of like a receivable. $60,000. Okay, so the due to would be what? So due to means that we owe somebody else.
Liability.
Just that quick, I forgot, 40,000. Okay. Come down here, investments.
Asset.
Yep. Taxes receivable.
Asset.
So. And vouchers payable.
Liability.
Liability. Wait a minute, did I put the taxes receivable, liability. Hold on. Now, there actually is one more thing we need. We need the fund balance. Now, remember though, the fund balance, we take the ending fund balance, so this will be the 280 from up here. So this is from previous page. Okay, now hopefully this thing balances. If it doesn't, I'm going to start crying. All right. So 120,000. Total liabilities. $100,000. Deferred revenues, or unavailable revenues. I'm just gonna move this one over. There's only one in there, so. And same thing here. Move one in there. That doesn't come out right. Oh, yeah, it does. Yeah, I think it does. Weird. So 400 plus 120. All right. Yeah, so these two, this is it. So we kind of have three of them now instead of just the two. We used to have liabilities and equity. Now we have liabilities, deferred, or resources, which can be deferred revenues. It could also be unavailable revenues. Deferred revenues are put off to the next year. Unavailable revenues, it depends on whether they've spent them on the right thing or not. It could be a number of different. And I think they're getting away from the yeah. I'm making this thing look worse. Let's just make it yellow. All right. Yeah, they're getting away from kind of using the word unearned because technically they don't earn anything. You know, technically all the revenues are unearned because it's not how they recognize revenue. Okay, so that's the balance sheet. And again, the wacky thing, nothing long term. You know, this is all short term stuff. This is all short term stuff. There's nothing long term on this balance sheet. It's the only thing they have the assets, they have what they owe, and that's pretty much it. And you say, well, what about the long-term liabilities and all that? You know, what about the long-term liabilities and long-term assets? They're on here, but they're the long-term or assets are in the expenditures, is where long-term assets would be. And the long-term liabilities are down here. They look like revenue coming in. So you know, up here you buy a building, it's not an asset, it's the expenditure. Borrow, you know, for 30 years, it's not a liability. Money coming in. Okay, question on that? All right, let me save this. I apologize, I thought we were getting done earlier than this. All right, well, 14 minutes early. Go enjoy the beautiful day out for 14 more minutes. 14 minutes earlier. All right, any questions on that? Okay, oh, we're done with this one, right? We finished it. So we can turn both those handouts. Okay, question on that? Okay, see you next week.
Good night.
Right.
Good night, Professor.
Good night.